clinic is busy towards the end of the year. It's also you're also trying to figure out all the logistics of the end of the year in terms of the business, the taxes, how to plan for the next year. There's usually a big tax payment due in January that you're kind of getting ready for, making sure the cash flow is there. End of the year is always a
Right.
busy time.
No, it is, man, for sure. And that's
But for
like
you as a surgeon, surgeons are busy.
very busy, right? I mean, every patient has met their deductible, and I mean, dude, for the last like 6 weeks, every patient that comes in is like, "Can you get me in before the end of the year?" It's like every single person wants to have their surgery before the end of the year. I'm like, I don't have any more OR time.
And when everyone's trying to get into emergency surgery, who else is busy doing cardiac clearances?
That's right. I've sent you quite a few of them.
Yeah, yeah. So I'm busy doing cardiac clearances. People coming in, oh, I need the surgery before the end of the year. Can you?
Yeah.
I need a clearance. I'm like, honestly, I'm booked out till December, end of December,
Yeah.
and I had to open up an extra stress test day because there weren't any spots for the stress test days I already had. So I had to open up another day for that. So it's
Dude,
it's it's
it's a
good.
good problem to have. That's good.
It's a good, but when January comes, the business does dip quite a bit. January and February for me are the slowest in terms of the volume is not the slowest, but in terms of the revenue collected and the collections, it's much lower because the insurances are changing and it's a little slow to pay at that time. So
Okay.
I always see the collections and revenues dip January and February, and that's why you have to kind of start planning. I wish thinking of like we're just talking about planning for the next year. It's crazy how less of a financial planning and wealth building education we get as physicians in medical school and through our training, right?
It's like non-existent.
Non-existent. I mean, I truly believe there should be courses in like high school for financial literacy, which this is something like I've just started learning, whereas I should have learned this like 15 years ago or 20 years ago. Yeah.
No, man, I hear you. It's like financial literacy and personal finance knowledge is it really doesn't exist. I mean, you have to actively seek it out. I mean, even people who have finance degrees, you're learning about finance in terms of the financial services companies and entering that workforce. It's not really geared towards personal finance. That's kind of something you just learn by reading or talking to financial advisors. And so I think, what we had discussed, this episode is really going to focus on that, is what is relevant personal finance that we have learned on our way, and honestly, a lot of the mistakes we've made and realized them, and what's worked for us and what hasn't. And I think this will be really relevant for a lot of the people, not just healthcare and doctors. It's anyone who is entering the workforce, finally getting a paycheck, coming into finally getting some money, and what to do with it, how to save, how to invest, how to still have fun and enjoy it. Um, and focus on things like that. So I think it'll be really interesting to talk about just our anecdote, but also kind of what we've learned along the way.
Well, I'm excited for this because this is going to be part one of two. Like part one will be us amateurs talking about some financial planning and wealth building. When part two will hopefully have a actual professional who will come in and kind of answer some of our questions, and I think hopefully answer a lot of questions for the audience as well and people who are listening. Some of their financial concerns and questions about what are some things that doctors can do, or even just any professional, not just doctors. I mean, not all doctors are unique in their financial. There's a lot of people making a lot of good money, and they need to know what to do with it. And there's it's funny. I read this thing recently. There's two things. There's being rich and being wealthy, right? And being rich is something that you see, like the cars you drive and the clothes you wear and the watches you wear and the restaurants you eat at and the vacations you take. That's being rich. But being wealthy is something you don't see. And a lot of people may seem rich, but they truly don't have any wealth. And there's a lot of people that do not seem rich at all and seem very modest, and they have tons of wealth, and you might be just surprised at how much wealth they have. So wealth is something you do not see.
Dude,
And
totally. A funny kind of aside on that topic is, that website Reddit, that everyone, you can go on and stuff. They used to have this very popular segment called AMA, right? Ask Me Anything. So I remember this exact topic. Mark Cuban, this is a long time ago. He did an AMA, And he was answering all these questions and stuff. And one person asked him, just I think they're just being funny, right? Have you ever gone to a strip club and made it rain? Meaning like taking a bunch of hundred, like $1 bills, hundred, whatever, and just like throwing them. And Mark Cuban's answer was hilarious. He was like, someone who thinks they're rich would do that. Someone who's wealthy like me wouldn't do that because that's just stupid. Where's the return on that? And I was just like, it's just hilarious. His mindset, his perspective was very different, but it's kind of what you're saying. It's not just for show. It's not just for flash, right? It's you build wealth also as an internal measure of success. It's not for the outside world only. I
Yeah.
think that's a very interesting thing.
It's an interesting thing, and and it's true. There's a lot of people. I mean, there's a lot of very documented facts about very wealthy people that live very modest lives. Like look at Warren Buffett, right? I
Yeah,
mean,
totally. The Oracle of Omaha.
he is an enigma, and he truly, lives a very modest life. He has a modest home and is not flashy, but he is one of the richest guys in the world. And the way he became a richest guy is he started investing at a very early age, right? He started investing small amounts of money and playing with the stock market or playing with the financial industries since he was 10 years old, and slowly that wealth grew. And there's a fact that I read that it wasn't until after his 60s that he made $82 billion. Before that, his net worth was much lower than that. It's a much smaller percentage. So most people think, I need to, kind of save up and build my wealth till I'm retired, and then I can live off. And this guy kept going, kept investing,
Yeah.
and that
Yeah, he
tells you
never
the power.
stopped.
He never saw it. Tells you the power of compounding, right? Compounding is this idea that everyone tells you, oh yeah, compounding, but no one explains to you what that is. But compounding is pretty much time of money invested growing over time, and with time growing exponentially, right? It starts off slow and takes time for it to get to a point where it can then truly accelerate. And the only way you get that is by discipline, uh, investment, or savings that grow on top of each other and eventually give you the returns that you need to be wealthy.
Dude, totally. That's something that like I personally, in hindsight, wish I had done differently when I was a bit younger. Like even, in residency training. I started residency when I was like 26 years old. And you start getting a paycheck. It's not a lot. It's a livable wage. I think, you could equate it. They've done a lot of research on like the amount of hours you put in and the value. It's something like between $8 to $10 an hour, at least at that time, based on how much we were working. But that's still not nothing. And to be frank, we were working so much in residency, you really don't have a lot of time to spend the money. So you do have forced savings. It's not a lot of money, but relatively, you still have a percentage from your paycheck that you can save and do something with. And I was smart in some things, I think, in terms of savings, but not others. I didn't really do a lot with my paycheck. Whatever was left, I kind of just left it in the bank. And I think a lot of people do that when my mindset was, okay, I just have to focus on blank right now, learning my craft, learning how to be a surgeon, and down the road I'll figure it out. I'll invest later when I have like what I thought real money, right? All money is real money, and I didn't really do much of that. I don't know if you did, Humaya, when you were in training, if you like actively saved or thought about putting aside blank amount each month or different types of investment or retirement accounts.
Yeah, it wasn't until much later, when I started early on, my the goal was to, hey, I'm just finally, after years of just having to live on loans and financial aid, I'm finally starting to make some money. At that time, that money that I made in residency seemed a good amount. I mean, I was making what, 60, 65K a year, which is a decent amount. It's more than a lot of people make. So yeah, you're working a lot, and you're working almost 80 hours a week, or sometimes more or less, but you're making a decent amount of money. But I did not invest like I should have. A lot of times, many people go to state schools for residency, right? University of Texas or Baylor College of Medicine, and people, the nonprofit organizations that have options of matching your savings as well, right? Things like 403b plans or 401ks, and investing in it is the smartest thing to do, because you can invest small amount and your employer can match those amounts to a certain percentage and help it grow even faster. But a lot of people don't even know. I personally was not even educated on where to put my money. I mean, I didn't even log into my accounts to see if I had the ability to save and have that matched. I was so just focused on, hey, this is the time that I'm going to focus on my residency. Yeah, in the future I'll make money, and then I'll start investing. And when it comes to investing, you get so overwhelmed because you don't even know what to invest. All your life as a 18-year-old, 20-year-old going through med school, you just hear about stocks. People invest in stocks and they make a lot of money, but you truly don't understand what that means. And at that time, you don't truly know what it means to have an index fund, or to invest in index funds or ETFs or just in the S&P. What truly is the S&P or Nasdaq or or Dow Jones.
Yeah, so let me ask you this, Humayun. How old were you when you bought your first stock?
My first stock was probably, I bought that sometime in residency.
Sometime in residency. Okay, so you were probably what, late 20s?
Yeah, mid late 20s. Yeah.
I got you. I got in the stock game a little earlier. I was a junior in high school when there's not much money. You accumulate a few checks from birthdays, when you're a teenager, and that's what I had in my savings account. It wasn't much, but like it was really my dad that pushed me. He was like, "Hey, the best way to learn about it is to have some investment in it. You have an emotional investment when you put your money in something. It's not just the amount." And it was nothing big. I think the first stock I bought was BP, the oil company BP, because at that time they had just had like that big oil spill in the Gulf of Mexico, and it was like tanking. So their stock had gone way down. I didn't know anything, but I was just like, "That's bad." And everyone says buy low. It can't get much lower than this, so I bought it. It was pure dumb luck. I mean, obviously they went up. BP's still around, but that was the first foray I had into stocks and investing and stuff. And the reason I asked you this question was because I think it's very different, like investing in the stock market, kind of like for fun and for learning rather than as a like retirement strategy. You know what I mean? Like they're very different things. Um, like now after getting older and having a financial planner, I don't dabble in the stock market as my means of retirement cultivation. Like that would be foolish. I don't have the time or the acumen to do that. I just kind of play around with it, but it helped me learn a lot about what a stock market is and stuff like that. So
Yeah.
that's why I was curious, because I think most people that go through medical education, residency, and training, they, for one, don't have the time or don't think they have the time to really dabble and play with the market. I think most of them probably are just of that mindset. Well, we'll wait. We'll figure it out later.
Yeah. Yeah, and it's important to know, right? At that time, when you're that young, like you said, you started early learning about stocks. For the first introduction I had to kind of investing is everyone was talking about cryptocurrency in my residency class. I'm
A
like, what
nice
is this
first.
crypto? Right? So I bought my first Bitcoin at that, like, first, not my first Bitcoin, but made an investment into Bitcoin around 2017, 2018, and put some money in there because I had some extra cash from just not spending it during residency, and I put some money in Bitcoin. Yeah, it paid off over time, and it did well, but it was not the smartest thing to do. But what I tell people is, best to have three different buckets, right? There's the long-term retirement savings. So when you have the long-term retirement savings, you think of things like of having a Roth IRA or a 401k or some kind of regular IRA, and that's your long-term savings. And then your middle savings, there's some kind of a investment growth account where it's somewhat liquid, and somewhat cash as well available to you to invest or use an emergency fund. And then there have some money just to play around with, where you put it in crypto or buy some stocks, or just to learn the market and what it means to invest into stocks. And that should not be a large amount. That should be something you should be willing to lose, right? It should be a small amount. But I kind of divide things into three different buckets, where I have something long term that's what I'm hoping they'll grow over time, build me, my retirement savings and, the wealth. And then there's a middle uh, portion, which is mainly for emergency funds or spending or making investments in the future, right? And then the fun aspect. But do you want to kind of go into the differences between like Roth IRA and IRA for people who don't really understand what a 401k is or
Yeah, I mean,
403b?
so yeah. So all of these, like, these numbers like 401k, 403b, all that stuff, it has nothing to do with like 401k, like 401,000. That's not what it is. It's just like tax code, and it's just like these. Numbers have just become a thing. It rolls off your tongue. So, okay, what's in your 401k? That's just the name of the account. Basically, these are just accounts, whether it's a 401k or 403b, these are like employer sponsored accounts that, depending on the company you work for, you have X amount from your paycheck that goes into them, and you can determine how much you contribute. And then your employer, in a lot of settings, also will contribute. And that's what matching is. And so there's usually a set percentage, like up to 3%, up to 5, up to 8% of whatever you contribute. Your employer will contribute up to that, and meaning they'll match it. Some companies even have like a multiplier on it that you contribute 3, your employer will contribute 6. It's like a double. That would be awesome. Basically, what that means is you should maximize how much you contribute up to, at minimum, what your employer contributes, because that's free money. Like if you are contributing 5% of each paycheck and your employer is going to match that, oh my gosh, you're just losing out on an opportunity to get an extra 5% that goes towards your retirement. The main catch, I guess, on these accounts is that since they are not taxed, you can't, I guess you can't really take money out of them without a penalty until retirement age. You can take money out of it, but then you're going to get a penalty on it. And so, the biggest benefit is it's a forced savings for retirement. And I think that's a really good thing, because it's the same thing you mentioned earlier, the compounding and the consistency of it, that it goes in every paycheck. You put it on autopilot. You don't even think about it. You don't even see it, because it's taken out of your paycheck before it comes to you. Like I've personally availed that. I use those accounts because, for the same reason, there's an employer match. Why wouldn't you do it? Um, you're getting free money from it. It's
Yeah,
just,
especially if you have an employer match. I mean, it's foolish not to do that. It's foolish
yeah,
not
I
to,
guess
because that's
that's
free
true.
money.
Not every company that you work for will have an employer match, but many do. A lot of them do, and it's even outside of healthcare. I mean, like if you work for, I don't know, an engineering firm, an investment bank, any financial services company, in retail, like there's so many different things that have some employer sponsored retirement account, and you should contribute to those. And they roll over, right? Like if I switch jobs, if anyone switches their jobs, you don't lose that money. It's not stuck with your employer. That follows you. You can take that and put it into your next job. So the money doesn't go away. Your account doesn't go away. It doesn't disappear. It's yours.
It's your money. And it's one of those things where a lot of people can even think about these things when they're looking for jobs, right? When you're looking for your first job, your second job coming out of your training or college, see what kind of matching they do for your retirement account. What are the retirement savings they're offering? Are they offering a two times 2x match, or 1-to-1 match for every saving? And that means every time you add $1 to your account, your employer adds another dollar, and that compounds over time. So those 401ks or 403bs that are employer sponsored accounts can grow very aggressively for retirement. And sometimes the amount of money you add is very low, and as it compounds over time, people can easily have money that they can live off a stable income after they're 59 and a half years old, right? A lot of people do that, right? There's a formula where if you've accumulated $2 million in your retirement accounts at 59 and a half years of age, when you retire, you can take out $78,000 as a yearly pay, just without it getting any lower number, right? $2 million produces, uh, I forgot exactly, 80,000 to 100,000
Yeah, it's something like that.
a
Yeah.
year for you to live off of. So a lot of people should avail that, and that's a long-term budget, long-term bucket that you're thinking about, and where you should be putting the money that's going to help you in the future in your retirement. And it doesn't go away, right? I mean, it goes on, and if something happens to you before retirement, it does go on to your next of kin as well.
Yeah, for sure. You can put dependents in there too. Another thing to mention, I think that's good to know, is a lot of these companies will have a vesting period, meaning you have to work for blank a number of years before you are so-called fully vested in your own account. Meaning, let's say you enter a job and you start this process. You contribute every month, your employer matches it, blah, blah, blah. You're getting this extra money into this account from your employer's match and all this, and you leave after a year. Um, and they will often say in the contract you'll be fully vested after 2 or after 3 years. So if you don't meet that time limit, then all of that money that was contributed is not yours. And there'll be some stipulation. Every company is different, but potentially you could lose all of that employer match that you were gaining. That's what fully vested means. That is really not all yours without any catch until blank time point. So that's another thing to consider. And that these all of this stuff, these are the benefits, right? When someone talks about a job, what are the benefits that comes with it? This is one of the main benefits is what is the retirement strategy that is offered by your job and how are they going to help you achieve that? Which Humayun, you talked to me about this. So that this is all from like the employed side. For you, since you aren't employed, you own your own and run your own practice. How do you go about something like this?
Yeah, I mean, there's a few different options, and that's kind of another. And I'll take a little detour and talk about this a little bit. When you're coming out of training and thinking about long-term wealth building, and how you're going to save for retirement and how you're going to save for your investments. Usually, the riskiest routes are the ones that pay off the most and provide the most opportunities. And this is a known fact that self-employment provides the most opportunities for savings, more faster savings, and even more chances of tax savings, right? And we know that tax savings and is what builds wealth a lot of times. The government has ways to incentivize business owners to do certain things, like have their employees do well as well. So have employees save, and that's why things like 401k are, businesses are tax incentivized to match for their employees as well. So for example, an employee is contributing $1,000 to their 401k a year, and whatever money I contribute to the 401k as a match is a tax deduction for me. That way, I'm helping employee build their wealth as well. I'm saving money on taxes because the government is incentivizing me to do that, and also retaining those employees, because if I have better benefits, then they're staying with me. So a lot of times we think of taxation and IRS as someone that's out to get to us, but a lot of times it is the government trying to incentivize us to do certain things that will be good for society as a whole, right? So as a business owner, there's a lot of different tax incentives that help you um, save and build your wealth and contribute towards your savings. Some of the things you can do, I mean, there's different options, right? So when you start off at a lower end and as an early small business, there's things like SEP IRA, right? Self-employed pension plan or self-employed pension IRAs, where you can contribute a certain percentage of your W-2 towards a certain percentage of your yearly income towards that IRA, and that saves and grows. And it's a way to save on taxes as well. The government's incentivizing you to save towards that. Then, as your business grows, you can add on 401k plan, and they can offer that to your employees. And when you offer that to your employees can start saving and building their wealth as well. And then there's things like cash balance plans as well, where there's actually calculations by actuarial analysts that tell you how much money to contribute towards each employee, and let that grow. But for me, as a smaller business owner right now, I'm focusing more on the SEP IRA and 401k. Uh, but I think there's many ways to do that. But in the end, the opportunities you get to build wealth as a self-employed person, you don't get that as an employed person a lot of times. I mean, what do you
No,
think
that makes
about that?
sense. I mean, it basically like the ability to use expenses, which are real. And so, like, the just to clarify for everyone listening, when people talk about like tax advantages or you can do X or Y or Z to decrease your taxable income, really all that means is you have a blank amount of money that comes in as revenue, whether you're employed and you get a salary or you own your own business and it comes from goods, services, whatever. So that revenue is potentially all taxable, but you can remove expenses from that. When you're an employee, you don't really have expenses because that's covered by your employer. So you just have your salary, and your salary, if you don't contribute from that into a tax advantaged account, like we just talked about, a 401k or a 403b, because that income comes from your paycheck. And then the remainder is what is your taxable income. So that's the real big benefit tax wise for an employee to contribute to these accounts is that the money goes out into these accounts prior to it hitting your taxable income. So it decreases that total taxable income. And what you're saying, Humayo, as a business owner or as an employer, you can use expenses, like you just mentioned, like the contribution, the matching contribution that you do for an employee, that comes out from your expenses and all the other business expenses. So it decreases the total revenue with all that stuff. And then that final number is what is ultimately taxed. And so that's really, it's like an incentive structure. That's really how the IRS code could be interpreted. It's not that people are, oh my gosh, they're using loopholes, they're shady. It's not shady. You just know what is considered a real expense and you make sure that you itemize it if it's going to help you. There's nothing wrong with
Yeah.
that. That is what a lot of people do who are well versed in the tax code.
And you want to be careful with that too, right? You don't you there's a chance to get audited, so you want to make sure you have a good CPA, a good accountant that's keeping track of things and documenting things well, and make sure everything that you have is also documented. So, as a business owner, when you take that risk of going into business and starting a new business, yeah, there's a huge risk of that business failing, but the advantages that come with it of much higher chances of savings towards building your wealth is I think a lot of times worth it, and that's why a lot of people do go into business, right? The government wants us to go and start new businesses and new ventures so we can start hire more employees and create more jobs, and that's why tax advantage loopholes, or not really loopholes, but incentive structures or deductions or plans like these are provided to business owners so they can be
Yeah, that's why they
incentivized to start a
exist.
business, right?
Right, right.
They want people to be employed and have jobs, so businesses are incentivized. So that's why, that's a big very useful move to make in the beginning, where I'm very happy that I did that, of being self-employed, because the advantages and the way you learn about these savings as a business owners, I've learned more in the past 4 years than I learned in my first 31 years of my life.
Yeah, you'll probably keep learning more too, right? I mean,
Yeah. So the other
it like opens your eyes, huh?
Yeah, the other thing I think I brought up earlier, I kind of want you to talk about that as well, the Roth IRAs and regular IRA.
Yeah, I mean, it's basically like when the tax is taken out. So for example, in a traditional, and to be honest, I always get them confused a little bit. I often have to look them up again. But what I recall is that a traditional IRA, the money that you put into it is already taxed. And so you don't have to pay tax at the end whenever you would take the money
The
back
other
out.
way around. So
Is that the
yeah,
other way around?
yeah.
So
So the
Roth
Roth IRA,
is,
so Roth IRA is something that you want to invest in early on. So usually people with a household income of around 170K, your husband and wife together, can only invest to that. You have to have a lower income level to be able to contribute to a Roth IRA. And Roth IRA is a lot of times post-tax money, money that's already you've paid taxes on. Uh, but what happens is that money grows over time, and then you
so when you
can
take it out, then
when you
it's
take
not
it out, it's
taxed.
tax free, because in the future your income is supposed to be much higher, right? And you're going to be in a much higher tax bracket. At that time, when you pull out the money, it's tax free, and you can use it, take advantage of that money tax free. Whereas a regular IRA is where you start contributing and deduct it towards taxes. So you, for example, you got paid $100,000 that year. You contributed $10,000, or I forget what the limit is for a regular IRA, but
It changes every year too.
it changes every year. Yeah, Roth IRA is usually 14,000 to $17,000. I forget how much a regular IRA is, but you contribute from the $100,000 you made, you contributed 14,000 for that year, right? So now you can only get taxed on $84,000 instead of, or $86,000 that's left over after contributing. Now that money grows, but it's not tax free. So when later on you take it out, it does get taxed. You know, so
Basically,
Roth,
you're deciding when you're going to be taxed, right?
yeah,
Like either you are paying tax now and then you contribute post-tax money, and then when you take it out when you're older, you're not taxed, or the other way around. You don't pay tax on it now. You put money into it before you pay taxes, so it does decrease your taxable income in the here and now, but then down the road you would pay tax on it. So it's really just a calculus of when you think it would be better for you
exactly.
to
So
have
when you're a
tax.
resident,
Yeah.
you're in medical school, you're a resident, you want to contribute or maximize, if you can, your Roth IRAs, because right now you have the lowest tax bracket. You're in the lowest tax bracket, and right now you're getting at the lowest percentage tax on that money that you're making. So you want to pay less taxes now, so you can take advantage of that money later on when you're in a much higher tax bracket.
Meaning, if
Uh,
you contribute to a Roth now, just to make sure I understand, so you contribute to a Roth today when your income is lower, meaning you're paying less tax, and it gets taxed. It goes into this account, and then when you take it out at retirement time, it's tax free at that time.
tax free. And at that time, you don't have to pay. At that time, your tax, you might be in the 35% tax bracket. Now, you got taxed on it for at 21%, and you're paying at a, now you're taking the money tax free, where you could have gotten the 35% tax on that money. The Roth IRA is something you do early on in life. So as a medical student or as a resident, when you have some extra cash and savings and you want to save and let that money grow, right? Because now when we talk about 401ks, 403bs, Roth IRA, that money is just not sitting in that account. That money is usually getting invested into different markets, right? So either some employers have their internal managers that manage the money, and they have certain funds, and you can just go in and choose you want aggressive, conservative, or medium, and you don't get to choose what investments you make with that money for a lot of 401k or 403b accounts, right?
Yeah,
But
you pick like
Roth,
the overall strategy rather than picking individual
yeah,
stocks.
exactly. Now, Roth IRA and a regular IRA is something that you open, right? So you can go on Fidelity or Charles Schwab or one of these websites, and then you can open up an account and Roth IRA or a an IRA, and you start putting money in that account, right? Now that money is gone, and you should not be able to you cannot withdraw that money until retirement at 59 and a half years old, but that money grows and you can choose where you want to invest that money in, right? So most people
Yeah, so it's basically it's just like a stock brokerage account. It's just like when you log into whatever your portal of choice is, like E-Trade, Schwab, it'll show whatever your normal stock trading account is, and then it'll just show your IRA right there. And like you're saying, the distinction is you choose to put money into the IRA up to whatever the limit is for that year, it is in there. And you can't pull it out now without a penalty until you hit the age later
yeah,
on.
exactly. And that money grows. So you can choose, and a lot of people, you can buy stocks with it. You can go and just put all your, put all your Roth IRA money into a Tesla account, and buy
Yeah.
Tesla stock and let it grow like that. And that's something idiotic that I did when I first opened up Roth IRA. I went in and bought all these random Apple or Tesla, but most prudent financial advisors or people who just know how to invest their money, they always advise you to invest into indexes or the market. Things like ETFs, index funds, just the S&P 500. And what S&P 500 is, a conglomeration of 500 different successful companies and their stock, and it kind of reflects the current market. Companies come in and out of S&P 500, and these are the top 500 companies. There's other indexes as well, like the Nasdaq, which is very tech heavy. And if you think the tech there's a big advantage in investing into tech, then you can invest into that, and that can grow at the rate of the market. So when you hear things like, "Oh yeah, I did better than the market, I beat the market," or "No one can beat the market," or "Nancy Pelosi always beats the market," they're talking about they're,
She does.
she does. Yeah, so follow her investment.
Insider trading helps.
Yeah. So, so when they say that, they're talking about the S&P 500, which is a bunch of 500 top companies and their stock. Um, so
Yeah, so
it's
the index funds is good too, but because especially like, for example, when I was in residency, it was the first time I had done a lot of like stock trading and messing around with stocks and ETFs and even some currency trading before that, just on my own. But that was the first time where I actually had a real like retirement account, because just like every other residency program, you're an employee, you have some type of retirement account. I was in Tampa in Florida, and so they had a special. It was called a TERP. TERP, a temporary employee retirement program, where it was just money contributed into the account every month from your paycheck, and it would grow, grow, grow. And you had the option when you logged in of, just like you're talking about, is divvying up however much percentage of your total portfolio. Let's say you got 10,000 bucks in there. I want to put 10% into aggressive heavy growth. I want to put 5% into very stable, not going to break the bank, but it ain't going to go down, and then anything in between. And so I was 26. I was like, well, this isn't that much money anyway. I don't really need it for anything right now. I'm not going to be able to touch it for a while. I'm just going to put 100% of it into the most aggressive option possible. That's just what I did. And I didn't even think anything of it. I didn't look at it again or whatever. And at the end of the 5 years of my ortho residency, I had about 60,000 bucks in there from like doing nothing and not even thinking about it after that one time I logged in. And two of my co-residents, they never even bothered to log in. Like, we all were told, you do your orientation and onboarding, like, oh, we all have blank, blank retirement. You have so much information thrown at you. They didn't even log in one time. And when they finished their 5 years, I literally had like 60K and I did nothing. It was just money that was being put in every month. I didn't even know about it. They had about 14,000 bucks. I mean, that's a huge difference. Even if, in the grand scheme of like, you live to 80 years old, okay, it may not be that much, but when I graduated, I was like, wow, this is like a nice pot of money. And it just keeps growing. And that just shows the compounding and the ability to grow if you just set stuff early on. And it wasn't invested in individual stocks, nothing like that. It was just a relatively aggressive index fund, meaning it just tracked a series of stocks which were known to have higher potential return, but obviously higher risk. That's all it was. It was just an index fund investment.
Yeah, index funds are great because usually index funds have a fee, right? So there's a fee because there's a manager that's
Yeah.
managing those investments, and those have a fee, but there is a higher rate of growth with that because that manager is making some prudent investments, and they have the knowledge, and they're trading for you in a sense instead of you having to go in and buy Tesla, sell Tesla. They're doing that for you, so that way it grows. Now, the worst thing you can do is keep as someone who has a full-time job and is working is keep checking your account and keep selling and buying new stocks every day, right?
You're gonna go
Because you
crazy.
yeah, you'll go crazy because what's going to happen is you're going to buy, for example, you bought a BP and next day they had an oil spill and it started dropping, and now you freak out and you start selling it because you don't want to lose all the money, right? And
Right.
then you see that, okay, yeah, now Tesla is going up, and then you invest into Tesla, and all of a sudden next day Elon Musk does something crazy, and then the Tesla stock starts crashing, and you're going to go crazy about that, and you're going to start selling. That way it's shown that people end up losing more money. There's three examples. One person, for example, that for 10 years they just rain or shine, recession, no recession, market downturn, uh, market booming, they just kept investing the same amount every month into the market, versus someone who watched and did what they invested in something that was doing well, and invested take sold something that was not doing so well. And the person that invested consistently on a monthly basis in rain or shine did much better than anyone else, right?
Yeah, I mean, it's kind of like the advice you get when you're a kid from your parents, like, hey, put $5 of your allowance away every time, every month. That grows. The consistency. It's not about the large amount. It's the consistency. Yeah,
Yeah.
that's a huge factor.
Yeah, the market goes up and down, right? Up and down, and it's kind of like a wave, right? A zigzag line, but it overall the trajectory is upward. So if you keep investing as disciplined and putting a little bit of your money into those accounts at a slow rate and let it grow, it's gonna grow, and not having to worry about these downturns. So there's a lot of mistakes I made. There's one of the things that I tell people, which is the biggest trap, is these investment accounts and knowing about these things is great, but when you don't have any money, it's even worse because right out of high school, you come out, and if you don't come from a family that's right now have money saved right away for your college, and college and med school can be very expensive, right? So you have to take out loans, right? And 18-year-olds all across the country are are being shown these, hey, you can just take $50,000 out every semester and pay for your living expenses and pay tuition, and people are just going about and taking these massive loans without understanding the consequences of these student loans, right? And because it's so easy to get the student loans, universities just kept raising their prices, and Red kept raising tuition because they know that students are going to get loans. They will pay the university, then the students can do whatever they want afterwards. But what, as an 18-year-old, you don't understand, and what is the interest rate? What will the interest rate means when you're trying to repay these loans, right? What is it better to just take out a private loan, or is it better to take out these federal loans? And those are some things you don't know about, don't think about, don't. And back, I guess, when we went to college, it wasn't as easy to just look things up on Chat GPT, right? So
Yeah.
so at that time, you just were like, oh, I'm getting money. I'm going to pay for my college and have a way to pay for my apartment and my living expenses. So that's the loan I'm going to take out. And you don't pay attention as much to any interest loans. And now when you're thinking about repaying those loans, you're like, oh man, like those are some of the mistakes I made. I should have made some smarter decisions, minimized the amount of loans I was taking out, and maybe not spent as much in
Yeah, it's
college.
easy to fall in that mindset, when you're that young and you need the money to get your education. Like, oh, I'll worry about it later, or that'll be a future Adil or future Humayun problem. Well,
Yeah.
the future is here, and now it's our problem.
Yeah. And luckily, I mean, I got lucky. I got into medical school. I became a physician, so it became easier for me to pay off these loans. But for a lot of people that may not end up getting into medical school, may not end up doing what they want to do, and maybe end up getting maybe getting a job that's not as high paying, then it becomes almost impossible, and people fall into the trap of these high interest student loans, and then they are never able to pay them off.
Yeah, you're trapped.
Student
It's
loans is not something you can default on. I mean, if you die, the student loans don't go away; they go onto your family, and your wife has to pay for them.
yeah.
So it's not something that just goes away, and that's the crazy part where young people going into medical school, going into residency, they need to know what student loans are and what they truly mean and what they mean for your future savings and your wealth building when you're ready to pay them off, and it's not as easy. So just be careful with that, and that's all I can say. I mean, it's tough. You know.
Yeah, no, it is for sure. I mean, it's just one of those. I mean, that's why if you look at the averages for people that go to professional school, whether it's MBA or law school or medical school, I mean, the average loan rates are so high. I mean, I think for med school, it's only like a little over 200 grand now is the average debt that someone comes out of when they finish. That's a lot. I mean, you're paying that off for like 10, 15 years easily. It adds another suck. It's another extra little tick in the box of what are your monthly average expenses just to be alive. You got your mortgage, your car, your kid's school, your grocery bills, and your student loans. I mean, it just adds up. So it's something to consider. And that's also why all of these other things we've been mentioning are so important to cultivate so that you can have a real plan and it's not just kind of random.
Yeah, and then I mean, you're absolutely right. These things add up, and when you start working, and then you have all these expensive, and then life creep happens, right? You start making a little money, and then you start buying a little bit more things, and maybe spending a little bit more money. You get a nicer car, um, and you just never know what might happen, right? A lot of people, stories of people that uh, went through med school, did residency, and somewhere along the line they got injured or got hurt or got sick, and they got disabled, right? And then they did not have the means to make the same kind of money. And that's why I mean, I personally feel getting disability insurance early on in residency, when you're healthy, you're safe, and the rates are cheap, and you can lock in a long-term disability insurance. I think it's important just to have that safeguard. It's not that expensive early on, especially when you're in residency. And knowing.
100%. 100%. That's what I did when I was in residency right at the end. Like is for anyone listening who hasn't gotten disability insurance or isn't aware, like you go through a full like physical exam, a history. It's like seeing your primary care physician. They do a bunch of labs on you. They check all your medical records. If anything and everything, anything at all is off, or you have some discrepancy, or you had some injury in the past, they'll try to get you on it. It's just like your insurance premium going up. So the younger you are, the healthier you are when you apply for disability insurance, it's going to be a lower premium annually for the rest of your life. And that insurance policy will cover you, God forbid, like you're saying, if you get injured and cannot do your job. It's also important whenever you get it, right? And these are the things, just like Humayun, you mentioned when someone's 18 thinking about student loans. Same thing when you're like in your late 20s thinking about disability insurance. Think of the future too. The amount that you get for your disability insurance policy, meaning the payout, God forbid, if you get injured, is initially going to be pretty low because you don't want to pay a lot of money annually. You're going to have a low premium, so you're going to have a low payout. But as you get older, you get family, you have kids and all that stuff. That small disability amount, God forbid, if you do get injured, isn't going to cover anything. So it needs to get higher. So you have to have some rider, some clause on there. Rider is just the term that these disability insurance companies use. Some clause that will allow you to raise your payout. Obviously, your premium will go up too, but raise the payout to a certain cap without having to go through a repeat evaluation. That's the biggest thing. You don't want to get to like 55 years of age when you realize, oh, shoot, my disability policy is not adequate. I need extra on it. Well, your premium is going to skyrocket just simply because you're older.
Yeah, yeah, exactly. And then, the important part is that once you pay that cheap amount early on residency, when you're converting, you don't have to go through any evaluation, and
Correct.
you stay with the same policy or change for a much increased amount. Other thing you got to consider about is the own occupation clause as well,
Yeah.
right?
Yeah. Yeah.
So that's another thing you got to watch out for, because and you got to make sure you have the own occupation, which means that if you cannot be an orthopedic surgeon anymore, that's when you start getting disability. It doesn't mean that you cannot work, right? So a lot of people might get injured, they cannot be surgeons anymore, and they might become consultants for some kind of big consulting firm. But that does mean you're not an orthopedic surgeon anymore, and with the own profession means that you're safeguarded if you cannot practice orthopedic surgery. It doesn't matter if you went on to consulting, you'll still get that disability insurance that you paid for all these years because you were planning on being a surgeon.
Yeah, I agree with you, man. I think those are the two most important things with it is make sure it's own occupation and to get that rider that you can increase it later on. It's funny. Like one of my friends who's also a surgeon, they had like a nerve compression in their arm, and they were having numbness, tingling, and weakness of their grip for quite a while, quite a few months. And they came to me and asked, like, "Hey, can you just do a nerve release, a cubital tunnel release for their ulnar nerve?" It's very common, very straightforward, easy surgery, right, and pretty good outcomes. And I just asked them, I was like, "You have disability insurance, right?" And they were like, "Actually, no, I don't." And I was like, "Dude, like I won't do the surgery on you until you get the disability insurance." Not that I was worried about my ability to do the surgery without harming them, but because if later they try to apply for disability insurance, it's going to be in their medical record forever that they have cubital tunnel syndrome. There is already some issue with this arm. So God forbid if they get into a car accident or something way down the road that injures this arm and now stops them from being able to do surgery, which is their job, the insurance company could come back and say, "Hey, this was pre-existing. This was before your policy. There's possibility that some of the sequelae is actually from that nerve compression," which has happened. Those are real examples that have happened to people. And so it's really important what Humayun, you were talking about earlier, is doing this early on in residency when you're younger and healthier than you ever will be, right? You're going to be healthier now that you will be tomorrow, and on and on. So it's just really important to do it early.
Yeah, so these are some of the things. I think we've touched on a few things that you got to do in residency and early career, right? But that first 2 years, the 3 years are very important when you come out of a fellowship, right, or residency. Those first 2 or 3 years is when you all of a sudden start making a large sum of money, and that's when things become a little easy for you. You're like, okay, I can now afford to buy a new car. I can maybe buy the dream house that I've been waiting for, and it all seems very reasonable at that time because the amount of money all of a sudden you were used to living on this 50, $60,000 salary, and now all of a sudden you're making 350K, 400K, $500,000 or whatever you're making. But it's very important at that time to kind of have a financial plan, right? When you're coming out of residency fellowship, have a financial plan. What are your goals in the next 10 years, 15 years? You want to make sure that you know where all your finances are. Have your bank accounts in front of you, any investment accounts that you have that maybe your residency helped you contribute and grow, like you had $60,000, any other stock accounts you have, make sure you have them in front of you, laid out, combined as one. This is currently my net worth, right? Including your student loans. Your most likely your net worth is in the negatives, right? And that is a good thing to think about. Now, there are certain books and things like White Coat Investor, which I personally hate the idea of that, right? They tell you, oh, live a resident lifestyle for the next 15, 20 years, live like you're still making $60,000, save a ton of money, and then you can just retire. And I personally do not agree with that. I mean, I do think that you work hard all these years, you've already delayed gratification, and there's time then you want to start enjoying your the hard work that you've done, and now you're getting paid. So you do want to enjoy that. So I do not agree with living in austerity, but you need to have a plan. And for me, it's always been having those buckets, right? Well, make sure that I'm paying myself first, paying those buckets first, filling those buckets, and whatever's left over is then I'm spending. And a lot of time, it's a good amount of money, right? You can still spend and enjoy your life and still do things, but make sure you have a plan. Okay, 10 years from now, if I keep investing $1,000 to this account, this is what I'll end up with. um, do not buy that dream car right off the bat, and do not buy that dream house right in the first 2 years of your being an attending. Wait a little bit, have a plan, and then if your finances allow and your overall goals allow, yeah, I mean, spend some money and enjoy life as well.
Dude, I hear you. I mean, I agree with you in that regard with the so-called "live like a resident forever" mantra. I don't agree with it because you have to live your life. You have to enjoy your life. Otherwise, what are you doing? And having a plan from the beginning is huge. And that's why I think if you start early, right? If you start when you're just leaving school, you're starting residency and training, or if you're not in medicine, whatever your first job is, your initial entry level position, as you grow older and you get more money, you get promotions, raises, all that stuff. If you have a plan early and you have the consistency and the habit early on of having some saving method that you contribute to regularly, that you can put on autopilot and just forget about, you're not really like waiting for some time point to start a plan, to start your retirement savings. You've already done it. You've done it the whole way through. So it's not even a thing. I think that's a huge and really important thing. It's more of a mindset than anything else. Just making it a
So
habit, making it a thing.
yeah, I'm excited, man. I'm excited to get into the weeds of that with what to do once you've kind of started your job and are making money now. What are some next steps you can take? I think we'll hopefully have our first guest, and we can kind of talk about these things and kind of go into the details of that. So looking forward to that conversation as well.
Yeah, that's an exciting stuff. Watch them say everything that Adil and Humayun just told you is wrong. Here's the reality.
One thing I'll say to everyone, I think it would be great if some people can, send us questions on YouTube or on Spotify or even on our Instagram or TikTok page of what they want to talk about or what questions they have. I mean, if there's physicians listening or there's any professionals or anyone in general just listening, maybe have some questions for us, and that we can even discuss with the professional, and ask on the show when this person comes on and gives us some very useful advice on what kind of tools we can use. So it'd be
Yeah, that
great to
make
see
it
some.
more fun and interactive for sure.
Yeah. All right. Well, this was a fun episode, and looking forward to more.
All
Thanks.
right, guys, we'll catch you at Two Docs One Mic later.